All right, today we're diving into something that really gets at one of the biggest headaches in Web3 investing. You know what I'm talking about, the classic pump and dump. We're going to look at a protocol called Honoris, which is proposing a whole new deal for investors, one that's designed to make fundraising, well, actually sustainable for once.
I mean, has this ever happened to you? You've done your research, you find a project that looks amazing, you get in early, the hype is real, you're watching the value of your investment go up, 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 and you're thinking, yes, I finally nailed it. But then the token actually launches.
And bam, just like that, it all vanishes into thin air. The price absolutely tanks. Why? Because the early insiders, the flippers, they all sell off at once. And guess who's left holding the bag? The long-term believers. All those amazing gains you were staring at on your screen, turns out they were never real. They were just paper gains. You see, this isn't just a case of bad luck. It's actually a deep, fundamental flaw in the way a lot of Web3 projects raise money. We're calling it the paper gains problem, and it's all built on a huge, glaring misalignment of incentives.
Okay, let's break this down. The old way, it's all about short-term hype and speculation. Let's be honest, investors are basically just exit liquidity for the founders and the big VCs. The whole system is set up to reward the people who sell the fastest. But the new way, the Honoris model, it's a total shift. It's about partnership. It's about actually sharing in the project's success and rewarding the people who stick around, the loyal holders who really believe in what's being built.
So the big question is, how do we actually do that? How do we flip the script from pure speculation to a genuine partnership? Well, it's going to take a totally new way of thinking about investing.
And this is where Honoris comes in. So what is it? At its heart, it's a DeFi protocol built on Solana that completely rewires the relationship between a project and its investors. The big idea is this: instead of just getting a bag of tokens, you get a real share of the profits that come from the project's actual trading activity.
Now, this is absolutely crucial. Your success isn't just about the token price mooning anymore. Instead, you're earning real, steady income, what we call real yield, and it's paid out in stablecoins like USDC. You get paid just because people are using the project. This means you get a much more predictable income stream, and it seriously cuts down on your risk.
So how does this all actually work under the hood? Well, it's powered by this really clever, self-reinforcing economic engine. Think of it as an automatic fee flywheel.
Okay, check this out. It's a 4-step cycle. Step 1, people trade the token, right? And every trade generates fees. Simple enough. Step 2, the Honoris protocol scoops up all those fees, but, and this is smart, it collects them in stablecoins so there's no market risk. Step 3, those profits get automatically shared every single day with the investors who've locked up their tokens. And finally, step 4, this is the real magic. Rewarding loyalty like this helps stabilize the token's price. A stable token attracts more traders, which means more fees, and the whole cycle starts over, spinning faster and faster.
Now there's some really key tech making all this possible. First, you've got a secure vault. It's controlled by code, not a person, so nobody can just run off with the money. No rug pulls here. Second, the stablecoin-only model is a massive deal. It means you completely avoid that nasty thing in DeFi called impermanent loss. And then, to make sure the right people get paid, it uses another system called Streamflow to check who the loyal, long-term investors are. And finally, everything is automated. A permissionless crank makes sure those payouts happen like clockwork, every 24 hours.
So what's the bottom line here? Well, a model like this isn't just a win for investors. It actually creates a much healthier vibe for the entire ecosystem. It's really a win-win-win situation.
I mean, look at the difference here. It's like night and day. A typical launch, it's a one-off fundraising event that just creates a mountain of sell pressure. But the Honoris model, it's about creating continuous, sustainable value by giving people a real reason to hold on. You're not exit liquidity anymore. You're a true partner. And this opens up access to real returns for everyone, not just the VCs behind closed doors.
And hey, this isn't just some theory on a whiteboard. Get this. A real-world project that launched using this exact model has already generated over $200,000 in trading fees for its early investors. That's on top of their initial investment. We're talking about real, tangible cash being shared back with the community.
So let's just recap who wins here. For startups, it's way easier to raise capital when you can offer a guaranteed stream of returns. For investors like you and me, you get steady, real yield income in stablecoins, which is just way less risky. And for the entire ecosystem, It builds so much trust, reduces those rug pull fears, and just leads to healthier, less crazy markets. The incentives are just perfectly aligned.
This model is more than just a small improvement. It really feels like it's pointing to a massive shift in how Web3 projects get funded down the road, especially when you start thinking about the big money, the serious, institutional capital.
So why would the big players care about this? Well, because it ticks all their boxes and solves their biggest problems. You've got secure custody that meets their standards. You have fee settlements in USDC, which gets rid of that pesky volatility risk. Everything is on-chain, totally transparent, which makes it auditable and regulator-friendly. It basically creates a DeFi version of a dividend-paying stock or a bond, something they actually understand.
And that leads to this powerful idea that Honoris isn't just another project. It's the missing link for institutions that want to get into Web3. It's the bridge they've been waiting for to finally let them jump into these markets with confidence and security.
Look, a model like this really feels like a sign of Web3 growing up. It's about replacing that frantic, short-term hype with actual, long-term value creation. And that leaves us with one last, really big question to think about. Could this finally be the beginning of the end for that pump-and-dump culture that's given crypto such a bad name for so long? I guess we'll have to wait and see.